Yo, let's get straight to it. There's a massive myth floating around that your crypto holdings are useless when it comes to buying a house. People think you have to cash it all out, turn it into fiat, and only then can you play ball with the big banks. That's old news. That's yesterday's thinking. The game has fundamentally changed, and as of February 2026, the landscape looks completely different. For all you entrepreneurs, freelancers, digital natives who have been grinding and building your wealth in the crypto space, this is your moment. The system is finally starting to catch up to where the real value is being created. Too many people with real assets get shut down by the traditional mortgage process. You know the drill. Lenders want 2 years of perfect tax returns, steady W-2 income, a financial history that fits neatly into their little box. But what if you're a creator? What if you're a business owner whose income fluctuates? What if a huge chunk of your net worth is in Bitcoin, Ethereum? The old system saw that as a risk. It saw you as a liability. The myth was that your digital wealth was invisible money. That myth is officially busted. We're entering an era where your crypto can finally get you the keys to a home. So, here's the roadmap. Simple and plain. So, why is this all happening now? It's simple supply and demand. Look around. An insane number of people own crypto, especially Gen Z and millennials. Nearly 40% of people under 40 have skin in the game. This isn't a niche hobby. It's a core part of their financial identity. The global crypto market is worth trillions. You can't just ignore that kind of value. The mortgage industry finally realized they were leaving a massive audience on the sidelines. An audience of future home buyers who are digitally savvy and who have significant wealth tied up in these assets. They had to adapt or risk becoming irrelevant. This shift is a lifeline for the self-employed and those with non-traditional income streams. The old system was built for the 9-to-5 employee with a predictable paycheck. It failed to account for the modern entrepreneur who might have a killer year, followed by a building year. Alright, let's get into the nitty-gritty. How exactly does your crypto help you land a mortgage? There are 4 main ways this works in the real world. Think of it as a 4-pronged attack to get your loan application approved. Infographic: down payment, closing costs, reserves, income. First up is the down payment. Lenders need to see that you have the cash for it. Present statements from your crypto accounts on regulated platforms. That proves you have the funds ready to go. You'll likely need to convert to US dollars for closing, but you don't have to do it months in advance to qualify. Second, closing costs. Same principle as the down payment. Closing costs can be a significant chunk of change. Lenders want to know you can cover them without draining your bank. Show your crypto holdings to demonstrate liquidity. Fees, taxes, other expenses. Key: a clear paper trail from a verifiable source. No off-exchange wallets from unknown sources. This shows stability and financial depth. Crypto can be a powerful tool. Don't think you can just show up with any random altcoin. Lenders are being smart and cautious. They're starting with the big players: Bitcoin, Ethereum. They'll also look at regulated spot ETFs that are backed by these assets. US dollar-backed stablecoins are also on the list. Your assets need to be held on US regulated exchanges or verifiable platforms. Some of these new policies allow you to use your crypto to qualify without having to sell it. Read that again. You can keep your investment in the market, letting it continue to grow, while still using its value to secure your mortgage. Many loans require reserves, a safety net. Now, some programs let your crypto count toward reserves. Lenders may apply a haircut or discount for volatility, but you can meet criteria without liquidating assets. Finally, crypto can be used to calculate income via asset depletion. Let's be crystal clear. This isn't the Wild West. You can't just screenshot your wallet and expect a loan officer to hand you a check. There are strict rules, and you have to play by them. First, this strategy primarily applies to non-QM and other non-traditional mortgage products. These loans are specifically designed for borrowers who don't fit the standard cookie-cutter mold, like business owners, investors. They offer more flexibility, but that comes with more intense scrutiny. You're not going to walk into any bank and have this conversation. You need to find the lenders who are actively building these programs. Documentation is everything. Provide a complete and transparent audit trail for your crypto assets. Lenders will want to see where the money came from to buy the crypto in the first place. This is called sourcing. They'll need to see a full history of your transactions. Your crypto must be held on a US regulated and recognized platform. They need to be able to log in, verify the holdings, and track the asset's history. Under-the-table deals and anonymous wallets are an automatic no. They know the market is volatile. They aren't going to give you 100% credit for the current market value. Expect a risk-based adjustment. For example, 70 to 80% of value to create a buffer.